Welcome to the Partners Table, where we connect with the brightest financial minds shaping the future of investing. I'm your host, Jesse Roldan. This podcast is for informational purposes only and should not be considered financial, legal, or tax advice. Please consult your own advisors and review the full disclosure in the description before making any decisions. The opinions and views expressed in this program do not necessarily reflect the official positions or institutional views of Zynergy or its affiliates. Today's guest has steered billions on Wall Street, built machine learning signals at U.S. Trust before AI fund was even a buzzword, and now leads a platform that moves seamlessly between public and private markets. His perspective on where capital goes next and how to approach it differently is one you won't want to miss. Larry McKay, welcome on to the Partners Table.
Thanks, Jesse. Good to be here.
Now, Larry, your track record is pretty remarkable. Building, as I mentioned, machine learning signals like random forests and SVMs at U.S. Trust, all while managing a $1.4 billion international book. You also have reshaped portfolio construction and risk at Chilton, and now at Zynergy you're building an AI-powered hybrid fund that blends institutional discipline with startup agility. Now, with that said, I want to start with the big picture here and get your take on what non-consensus secular forces, whether technological, demographic, or geopolitical, are actually reshaping where and how capital gets allocated over the next decade.
Yeah, thanks for that question, Jesse. I think the biggest one is probably the democratization of alternative investments right now. So in other words, for your average Joe, they really can't access a lot of the private market investments. So private credit, private real estate, private equity. But big players like BlackRock and Blue Owl are pushing to actually be able to get those into 401ks. So whether they insert a piece into target date funds or they allow that fund investment directly, that's something that a lot of people feel a little bit uneasy about, as you can imagine. On the one hand, it's good to give investors that flexibility, but on the other, do they really understand the risks involved with, not only the asset class, but how it's priced, how easy or difficult it is to get out of, and things like that. I think obviously another big one is the de-globalization that's been going on the past few years, where we went through, a good 20, 30 years of focusing on exactly the opposite. Like, how can we get more integrated? How can we kind of specialize on a country by country level and sort of outsource pieces of our economy, if you will? And the idea obviously was that it would benefit the greater good and everyone would kind of do better. I think functionally what ends up happening is that the countries that are lower income countries benefit the most, and the countries that are high income countries, kind of take a hit in terms of, manufacturing jobs lost in the U.S., for example. You can point to other things like that, across the developed world. So now that's getting reversed because people are obviously, I think, noticing that, and they want to bring more stuff home to their local economies. And so obviously Trump has sort of accelerated that with tariffs, et cetera. But I think that's going to have a wide-ranging impact, not just in the U.S., but really throughout the world. And then if I were to point to a third one, I don't want to talk about the AI revolution because everyone kind of talks about that. But one other component that a lot of people may be overlooking is national defense. So the U.S. has historically probably spent more than any other country on national defense. It got us the internet. It's gotten us things like infrared capabilities and things like that are used much more broadly. But now the latest NATO agreement is basically to more than double the amount that they're spending on defense, which is going from 2% up to 5% over the course of the next 10 years. So obviously that's going to have, that flow of dollars is going to pick up certain industries more than others. And it definitely shows you, where everyone's head is at in terms of concerns there.
That's great. Thank you for that perspective. To build on that, which regions or innovation hubs feel genuinely primed for outsized value creation, and where is investor attention still being misallocated?
Yeah, so I'll say a couple of things about that. One is that, historically as U.S. investors have really ignored the international markets, and I mean both international developed as well as emerging markets, because the US has just generated much better returns, much better technological progress that has led to those higher returns. And so a lot of people have been shunning those global markets. But now I think a lot of that is going to change. I think AI opens up, capabilities that weren't there before. I think that you see the populist movement in Japan that happened in the election over the weekend. So people are becoming more domestically focused, but they're also catching on to the AI wave. And I think there's going to be pockets of innovations and sort of second and third order effects that a lot of people aren't seeing now. One of the more obvious ones is the U.S. shift away from China, which has been kind of like a multi-year effort. But the focus tends to be on the China side of things and not where all of that money, capital, services, goods, or whatever is getting reallocated to. And that's mostly a combination of Mexico and Southeast Asia. So Vietnam, India, and Mexico are definitely three countries I think to watch in terms of how they can benefit from that effort.
Yeah, you're pointing to a big shift, not just away from China, but towards a more diverse set of winners or beneficiaries. Now, that said, with the US turning inward and tensions with China intensifying, how does that shift your risk modeling and alter your opportunity set?
Yeah, I mean, I think obviously, like, you'd want to look at, within the US, what companies and what areas are going to benefit the most. Obviously, there's a lot of industries that we haven't had here for a while, or that we don't do well here. But now that we know that that's kind of the direction of things, people can make multi-year investments that didn't make sense a few years ago. And so I think we will see a resurgence of certain industries. I think a lot of, whether it's like fabs for like semiconductor manufacturing, or whether it's, rare earth mining or something like that, I think we're going to see a lot of, opportunities there. And I think we'll see a lot of domestic growth. And I think the same thing will happen elsewhere as well, where, Europe isn't technically, hasn't historically been a technology powerhouse and not really thought of as being very innovative, et cetera. But I think that, there's certain necessities, I guess, that come out of this that may cause a lot of these countries to reinvent themselves and reinvent, their whole structure.
Hearing you lay out how certain industries are coming back into focus makes me want to paint a quick picture for our audience. If you were putting $100 million to work tomorrow under Zynergy's philosophy, how would you think about liquidity, thesis maturity, and AI-driven conviction?
So I think one advantage that Zynergy has is our open mandate to be able to invest globally across market caps and to have that hybrid structure with both publics and privates. So we're not forced to make an allocation in a certain space at any given point in time, right? So that gives us the flexibility to kind of start where we want to and shift that around as things change, right? So I think now one of the big opportunities is, private equity. It has been getting hit by higher interest rates, no question about it. But that doesn't mean there's no opportunity either, right? So there's a lot of obviously AI innovations and things like that. So I think, in deploying money day one, obviously public markets are starting to open up now. I think the big beautiful bill is going to benefit small caps and big caps a lot, being able to expense, the R&D has a multiplier effect on them where it's going to marginally help out large cap companies. And so I think we'll see a resurgence in small caps and mid caps in the US. We already kind of covered how other countries might benefit from kind of general de-globalization efforts. And so I think we're sort of spreading capital around to different pockets that may have been underserved in recent years just due to the investment landscape. And at the same time, obviously being able to opportunistically deploy capital on the private side without feeling the pressure to do it immediately or without seeing any good deals. We can wait for the right timing on that. And I think that's a big advantage that we have.
I want to expand on what you were just saying there at the end. You started to go into the advantages of a hybrid fund, and I'd love to hear more on that point since I think a lot of funds stick to a more traditional structure. Why build Zynergy as a hybrid or evergreen platform? And what moves can you make that a traditional private equity or long only vehicle simply can't?
Yeah, so I think that one big complaint I hear from a lot of family offices is that two things. One is, okay, I really like this private equity investment that I'm in, but it's in a fund structure, so no matter what, at the end of that 10-year period, they're going to be forced to exit. So you could be leaving a very profitable cash flow generating business that you like, whether you want to or not. So that's on the exit. On the entry point, a similar issue happens, right? Where you have this committed capital that may sit dormant for 2 to 3 years or even never be called away. And so it's just sitting in cash, T-bills, something similar, and you're unable to take advantage of that. So I think with the hybrid structure and the evergreen structure sort of combines to alleviate both of those issues where you have, the flexibility to deploy capital, knowing that you're not going to, sit on money that's not earning you anything. But at the same time, when those market opportunities do occur, you're able to take advantage of it in a structure that's both mostly liquid, but benefits from the upside, outsized returns in private equity as well.
That point about avoiding forced exits or idle capital is huge, especially for family offices who've been frustrated by both. It also makes me think about how you decide when to size up or step back from positions. As mentioned before, you've run a $1.4 billion concentrated equity book. So what's your rule book for conviction sizing today? And what's an anti-rule you follow that might make a conventional allocator uneasy?
So I think one thing to keep in mind, and I'll borrow this adage from Richard Shelton, my former head, um, where he basically said we water our flowers and we trim our weeds. So a lot of people take a defensive approach and say, okay, well, if we really like the stock and it goes down, buy more. But I think more often than not, that's sort of like you're kind of playing, anchored to this sort of behavioral mentality of not wanting to lose, as opposed to accepting the reality that, maybe there's no catalyst there, or maybe the company is not really going to get fully recognized at the valuation that you expect it to. And so, I tend to deploy more capital into things that are working and cut capital from things that are not. And I think that responsiveness kind of, really trickulates down to every asset class, to every market scenario, where as things go up, you outperform. And as things get worse, you sort of outperform on the downside as well, because you're trimming faster and you're making those adjustments. So I think that's important. Another aspect that I would point to is that a lot of people are bottoms up fundamental stock pickers, and I think that's a useful thing, but I don't think it's useful to look at that in a vacuum. I think everything needs to take into account what secular trends are in place, what the macro landscape looks like, all of which is constantly evolving. So the ability to kind of think through how that impacts individual stock positions, rather than just sticking to this kind of rigid bottoms up philosophy, is also incredibly helpful. And I think, that responsiveness historically has enabled me to get, I would say, substantially higher returns on the upside, and to kind of minimize the losses on the downside. And I think over longer periods of time, you'll really see that effect start to compound.
Yeah, that's a great perspective and philosophy. Stay responsive to what's working and avoid being anchored to what's not. It ties into another trend we're seeing, that being the surge in private allocations from family offices and emerging managers. From your seat, what's genuinely smart about that shift, and where do you see herd behavior that could punish returns?
Yeah, I mean, I think anytime you see something getting overly crowded, that the people on the other side of that, which is the people that are making those products, are sort of more incentivized to just get more deals done so they can collect more capital and deploy more capital. And so we saw that obviously in private real estate a few years ago, and then you got gating from a lot of these private funds. Now we're seeing that in private credit, which still continues to do well. But I think at some point, you're also going to be kind of dumpster diving with respect to private credit opportunities, And as an investor, you don't want to be the one that gets caught holding the bag. And so I think that there's, a certain level of prudence that needs to take place there. I think, as we touched on earlier, private equity with the higher interest rate levels, it's sort of tougher to sort of justify some of the financing opportunities for those deals. But I don't think that that's going to be the case forever. And I think the market's going to adjust to that. And you'll probably see, pricing come down to a point that makes sense, because obviously, we're in a higher interest rate environment than we've been in the past 15 years or so, but not high by, long-term 100-year standards, right? So I think, they found a way to make this work back in the 80s. We will find a way to make it work again, but I think the prices just need to adjust, and investors need to be aware of when that adjustment may happen so that they don't get caught at the wrong time.
I know you said earlier you didn't want to talk too much about AI because everyone's talking about it in this day and age, but in this world where AI is super prominent, I know that there are always audience members that would love to hear about it. So on that note, AI is still reshaping investment toolkits, from quant dashboards to retail-facing stock-picking apps. What actually makes Zynergy's AI edge durable rather than just louder?
Yeah, I think like the biggest thing I would point to is that we do, and we always intend to, leverage AI to identify opportunities. So think of it as like a funnel. The top of that funnel might be the AI filtering process that we use, but I would never use AI to like 100% pick stocks. I mean, if you're doing a quant fund or something like that, or maybe high frequency trading, things like that, I think, that's a useful quiver to have in your arrows there, but or arrow to have in your quiver there. But I think, from our perspective and for longer term investors, that makes less sense as solely relying on AI, but really it's just another tool in the toolkit that can help you identify opportunities that you maybe wouldn't have identified otherwise. And I think particularly, for us, since we're a global fund, no one can track thousands of equities that are out there efficiently, right? And AI gives you an opportunity to at least make a first pass at that and identify companies you could spend your time in an efficient manner to dig deeper into and see if that's a true opportunity or not.
Yeah, that's a great point. AI works best as a tool that strengthens decision making rather than replacing it. For investors who want to work with a fund like Zynergy that uses that kind of discipline and values the flexibility you've been describing, what's the best way to engage, co-invest, or align on a thesis?
Yeah, I mean, obviously, just reach out to us. Let's have a conversation, right? I think dialogue is important, and I think that especially for our early investors, they have an opportunity not only to get in at attractive pricing, but also to kind of participate in that conversation. And we'll learn stuff from them; they'll learn stuff from us, and hopefully, we're all better off for it.
Well, Larry, on that note, this has been an extremely valuable conversation, and we just really appreciate your time and insights and for joining us here at the Partners Table.
Anytime, Jesse. Thank you.
Thanks for joining us at the Partners Table. If you found this conversation valuable, please share it with someone who'd appreciate it. If you're ready to explore new investment opportunities, please visit our website, Zynergy.com, to discover how we can help you deploy capital with purpose. I'm Jesse Roldan, and we'll see you next time.